Banking laws and policies. Banks and the banking systems vary from one country to another. They differ not only in particular institutional practices, but more fundamentally in the general setting and historical experiences of the particular country. Such differences can help illustrate some of the general requirements of a successful banking system, and also to evaluate the effects of particular policies. Requirements for a banking system. Like so many other things, banking looks easy from the outside. Simply take in deposits and lend much of it out, earning interest in the process and sharing some of that interest with the depositors, in order to keep them putting money into the banks. Yet we do not want to repeat the mistake that Lenin made in grossly underestimating the complexity of business in general. At the beginning of the 21st century, some post-communist nations were having great difficulties in creating a banking system that could operate in a free market. In Albania and in the Czech Republic, for example, banks were able to receive deposits, but were stymied by the problem of how to lend out the money to private businesses in a way that would bring returns on their investment, while minimizing losses from money that was not repaid. The London magazine, The Economist, reported that the legal infrastructure is so weak in Albania that the head of the bank there is afraid to make any loans. Even though another Albanian bank made loans, it discovered that the collateral it acquired from a defaulting borrower was impossible to sell. An Albanian bank with 83% of the country's deposits made no loans at all, but bought government securities instead, earning a low but dependable rate of return. What this means for the country's economy as a whole, The Economist reported, is that capital-hungry enterprises are robbed of a source of finance. In the post-communist Czech Republic, lending was more generous, and losses much larger. Here, the government stepped in to cover losses, and banks shifted their assets into government securities, as in Albania. Whether such problems will sort themselves out over time, and how much time, is obviously a question for the Czechs and the Albanians, but it will take time for private enterprises to acquire track records, and private bankers to acquire more experience, while the legal system adapts to a market economy after the long decades of a communist economic and political regime. However, for the rest of us, their experience illustrates again the fact that one of the best ways of understanding and appreciating an economic function is by seeing what happens when that function does not exist or malfunctions. As with Britain several centuries earlier, foreigners have been brought in to run financial institutions that the people of the former communist bloc nations were having great difficulty running. As of 2006, foreigners owned more than half of the banking assets in the Czech Republic, Slovakia, Romania, Estonia, Lithuania, Hungary, Bulgaria, Poland, and Latvia. The range of the bank assets owned by foreigners was from 60% in Latvia to virtually all in Estonia. In India, a very different problem exists. While the country's rate of savings, as a percent of its economy's output, is much higher than that in the United States, its people are so distrustful of banks that individuals' holding of gold are the highest in the world. From the standpoint of the country, this means that a substantial part of its wealth does not get used to finance investment to create additional output. Of those savings which do go into India's largely state-dominated banking system, 70% are lent to the government or to government-owned enterprises. In China, where the rate of savings is even higher than in India, 90% of those savings go into government-owned banks, where they are lent out at low interest rates, which in effect subsidize government-owned enterprises that typically have either low rates of return on the capital invested in them or are operating at a loss. In short, most of China's savings are not allocated to the most efficient and prosperous enterprises, which are in the private sector and may be foreign-owned, but are sent to government-owned enterprises by government officials who run the banks. However much the situations in India and China differ from what is required for the efficient allocation of scarce resources which have alternative uses, it is very convenient for government officials. If private banks were allowed to operate freely in these countries, those banks would obviously lend or invest wherever they could safely get the highest rate of return on their money, which would be in firms and industries that were most prosperous. The private banks would then be able to offer higher interest rates to depositors, thereby attracting savings away from the state-run banks, which are paying lower rates of interest. The net result would tend to be both higher rates of savings in response to higher rates of interest paid on bank deposits, and the more efficient allocation of those savings to the more successful businesses, leading to higher rates of economic growth for the economy as a whole. But it would also create more headaches for government officials trying to keep government-run banks and government-run enterprises from going bankrupt. While economists might say that these inefficient enterprises should go out of business for the good of the economy, people with careers in government may be unlikely to be so willing to sustain damage to their own careers for the good of others. Government and risk. While banks manage money, what they must also manage is risk. Runs on banks are just one of those risks. Making loans that do not get repaid is a more common, if less visibly spectacular, risk. Either risk may not only inflict financial losses, but can do so to the point of destroying the institution itself. As already noted, government can do things that either increase or decrease these risks. Insecure property rights are just one of the things within the control of the government that has a major impact on the risks of banking. Because banks are almost invariably regulated by governments around the world, more so than other businesses, because of the potential impact of banking crises on the economy as a whole, the specific nature of that regulation can increase or decrease the riskiness of banking. One of the most prominent ways of reducing risk in the United States has been the government's Federal Deposit Insurance Corporation. However, there was state deposit insurance before there was federal deposit insurance. These state deposit insurance laws were brought on by the increased risk that many states had created by forbidding banks from having branch offices. The purpose of outlawing branch banking was apparently to protect local banks from the competition of bigger and better-known banks headquartered elsewhere. The net effect of such laws made banks more risky because a bank's depositors and borrowers were both concentrated wherever a particular bank's one location might be. If this was in a wheat-growing area, for example, then a decline in the price of wheat in the world market could reduce the incomes of many of the bank's depositors and borrowers at the same time, reducing both the deposits received and repayments on mortgages and other loans. State deposit insurance thus sought to deal with a risk created by state banking regulations. But state deposit insurance proved to be inadequate to its task. During the 1920s, and especially during the Great Depression of the 1930s, the thousands of American banks that failed were concentrated overwhelmingly in small communities in states with laws against branch banking. Federal deposit insurance, created in 1935, put an end to ruinous bank runs, but it was solving a problem largely created by other government interventions. In Canada, not a single bank failed during the period when thousands of American banks were failing, even though the Canadian government did not provide bank deposit insurance during that era. But Canada had 10 banks with 3,000 branches from coast to coast. That spread the risks of a given bank among many locations with different economic conditions. Large American banks with numerous branches likewise seldom failed, even during the Great Depression. Deposit insurance can create risks as well as reducing risk. People who are insured against risks, whether banking risks or risks to automobiles or homes, for example, may engage in more risky behavior than before now that they have been insured. That is, they might park their car in a rougher neighborhood than they would take it to if they were not insured against vandalism or theft. Or they might build a home in an area more vulnerable to hurricanes or wildfires than they would live in if they had no financial protection in the event that their home might be destroyed. Financial institutions have even more incentives to engage in risky behavior after having been insured, since riskier investments usually pay higher rates of return than safer investments. Government restrictions on the activities of banks insured by the Federal Deposit Insurance Corporation seek to minimize such risky investments. But containing the risk does not make the incentives for risk go away. Moreover, the government can misjudge some of the many risks that come and go, and so leave the taxpayers liable for losses that exceed the money collected from the banks as premiums paid for deposit insurance. As in China, India, and other countries where government officials intervene to direct lending to borrowers favored by government officials, rather than to borrowers to whom bank officials were more likely to lend money otherwise, so in the United States, the Community Reinvestment Act of 1977 sought to direct investment into low-income communities, including home mortgages for low or moderate-income individuals. Although more or less dormant for years, the Community Reinvestment Act was reinvigorated during the 1990s in a push to make home buying affordable to people whose low incomes, substandard credit history, or lack of money for a 20% down payment made getting a mortgage loan approval unlikely. Under government pressures and threats, banks began to lower mortgage loan approval standards in order to meet government goals or quotas. The net effect in the United States, as in other countries, was riskier lending and higher rates of default in the early 21st century. This contributed to the collapse of banks and other lending institutions, as well as Wall Street firms whose mortgage-based assets value was ultimately dependent on the monthly mortgage payments that increasingly failed to materialize.